Hello guys, welcome back to Channel for Trading. Today we are starting a new series of educational videos regarding options. It is called All About Options Trading from Basic to Option Strategies. Like other videos in YouTube, we won't be talking too much into theory of options. Rather, we will focus on options trading, how we can trade options by knowing the minimum needed. Once into it, we can develop knowledge and develop our own strategies. I'm planning this series to have new videos every weekend. On weekdays, we will continue to have our post-market analysis and intraday stock selection live stream going. So there is no change to it. This is an addition to the weekends. So let's get started. So we will start with understanding options. Then we will look into the risk profile chart. And then we look into the 4 basic option strategies: long call, short call, long put, short put. Basically, these 4 strategies are the building blocks of any strategies which is used in options. So these basic 4, for example, you can take it as 1 short call and 1 long call. You can use this together to form a strategy, and any permutation combination out of these 4, you may be able to build your own strategy. Understanding these 4 is very important, and it is very simple also. So let's go forward. Okay, before that, let's look into what exactly we are going to deal with next episode. So we will talk more about option Greeks and how option Greeks affect option premium. What will be the option Greeks for each of the 4 basic strategies. All these we will see it in the next video, and after that I'll be doing the income strategies. So that is how I have planned this series to go forward. So if you have any suggestions on the content, please let me know in the comment section below. So let's continue. First, we will look into understanding options. So what are the categories of the options we have? Currently, we have stock options and index option. Your stock options also have call option, put option. Your index option also have call option, put option. And the call option is denoted by CE and put option is denoted by PE. So what exactly is E denotes in that particular CE denotation? So CE, C stands for call option and E denotes the European style settlement. We have European style settlement and American style settlement. In European style settlement, you can exercise the option only at the day of expiry. In American style settlement, you can exercise the option at any day. That is a difference. So in Indian stock exchange, we are using European style settlement. So we can exercise the option only on expiry day. What do you mean by exercising your option? So that means right to buy the stock or the underlying asset, you can utilize that on the day of expiry, because basically options means a contract, right, between 2 parties, between the buyer and the seller. So you can exercise that buying on the day of expiry. So the buyer has to, if the buyer wants to buy, he can buy it on expiry day and the seller has to give the shares. Okay, we will stop there. I'm not going more into the explanation of that. It will come in the later slide. So what are the types of trading in option? You have call option that indicates long call, buy put option, we call it as long put, sell call option, we call it short call, sell put option, we call it short put. Why we are not saying it is buy call? Why this term long call? Because in options, we are not really buying or selling at that particular moment. It is only a contract. The buying or selling will happen at a later point, that is the expiry date. If we are closing it before that, it will not happen. So instead of buy call, we call it as going long, because there is no actual buying happening. That is the reason it is termed as long. We will only use long and short in going forward. So sell also, we are not actually selling anything. It is only a contract, right? So it will be termed as long position and short position. This holds good in terms of options trading and also in the futures trade. Only in the cash segment, actual buy and sell happens right there. So let us look at this picture now. Options, as I said, we have 2 stock options, index options, and we have call option in that also, put option also in that. Similarly, index option also has call option and option, and inside that call option we have long call, short call. Here also we have the same long call, short call. In for put option we have long put, short put. Similarly, long put and short put. I'll remove all this. Let's go forward. So understanding options, we are continuing. What is a strike price? That is the very basic terminology. For better understanding, I will give you an example. Suppose Nifty is trading at a price of 13,530. So today the Nifty spot price is 13,530. Consider that way. So we are, as from a buyer or a seller perspective, if they are making a contract for a Nifty spot price of 13,700. Then that 13,700 is called as strike price. So it is basically the price at which the buyer and seller is making a contract. That is called the strike price. Hope you understood that. Otherwise, put it on the comment. I will try to talk to you separately. So what is ATM? ATM is at the money. So what is at the money? If the option, suppose the same example what I gave, the Nifty spot price is 13,530. The strike price, if you have chosen, is 13,500. Then for a call option, you have chosen the strike price as 13,500. Then that becomes at the money. Okay. So if the stock price is equal to the strike price, then it is called as at the money. So for call option, for Nifty, for example, if Nifty is having option chain for every 50 rupees, that means 13,500 there is a strike price, and the option chain 13,550 there is a entry in the option chain, then there is a 13,600. So all these 50 rupees apart, if you have option chain in Nifty, then that means from 13,500 till 13,549 for a call position, at the money will be 13,500. Okay, you understood? At the money equals the strike price equals your spot price is called as at the money. If you have for a call option 13,500, if you're choosing the strike price for a call option as 13,500 and the Nifty spot is at 13,530, then that 13,500 is known as at the money. Your strike price is at the money. Okay, what is in the money? So in the money is also similar. Whatever strike price you have, if this for a call option I'm saying, okay, for a call option, if your strike price is lesser than your spot price, then that is known as in the money. So if the Nifty is trading at 13,530, then all the Nifty strike price 15,300, 13,500, 13,450, 13,400. So you got it right. All these things will be in the money. These all the strike prices, which is basically below this one, will become in the money, including the at the money. So 13,500 is at the money here. In the money becomes all the below strike price will become in the money. Okay. So what is significant on in the money, at the money? We will talk about that later. Okay, I'm clearing this, and we will talk about what is OTM, out of the money. So out of the money is if your strike price is greater than your spot price, then that is known as out of the money. That means if your Nifty is trading at 13,530, all the strike prices of 13,550, 13,600, 13,650 and all the way whatever we have, all these things are known as out of the money. So whatever is below becomes in the money, whatever is below becomes in the money, and whatever is on top of this will become out of the money. Okay, I hope you have understood this. This is fairly simple concept in case of call option. And for put option, this reverses. At the money for put option, at the money is the same, strike price equal to spot price. Okay, that is your at the money. In the money will become different. In the money will be your strike price greater than your spot price. Understood? Your strike price, that means if the Nifty is trading at 13,530, 13,550 will become your in the money. For a call option, this is your out of the money, right? But for a put option, for a strike price, if your Nifty is trading at 13,530, then in the money becomes 13,550 and all the prices above this 13,600, 650 and goes on like that. All this will become in the money. For a call option, all these will become out of the money. Okay, at the money is the same if your strike price is equal to spot price. Okay, so in this case, if your Nifty is trading at 13,530, then 13,550 will become your at the money in case of put option. But in case of call option, your at the money was 13,500. So that is the difference. Even though the concept is the same, but the prices are different. For a call option, you have to always select at the money as whatever the round figure is below your actual price, spot price. That is your at the money, and all the values below this is your in the money. Okay, so for put option, it is just the reverse. If Nifty is trading at 13,530, what will be the OTM for PE? All the strike prices which is below this, below your spot price. Whatever is below your spot price will become out of the money, right? All these things, 450, 400, all these things will become your OTM. Got it? This is very basic, and if you are not able to understand this one, please see the video again. And even if you are not able to understand even after watching the video again, just put it in the comments. I will explain to you separately, because this concept is very important. Okay, now let's come on to the next one. What is lot size? So lot size is nothing but number of shares or number of assets you have to buy or sell together. That is called as lot size. For example, in the case of Nifty, your lot size for Nifty is 75. That means one lot size is equal to 75 shares of Nifty. Okay. So similarly, one lot of Bank Nifty is equal to 25 shares of Bank Nifty. So this will keep on changing. Previously, if you remember, at the time of March, April time frame, the Bank Nifty was 20. One lot was 20. And then it changed to 25. So what is the rationale behind this? The contract should be minimum of 5 lakh rupees. So the future value, when the Bank Nifty was dropping, right, due to the COVID situation, the Bank Nifty was dropping and it almost reached 18,000. If you multiply that into the lot size, 18,000 into 20, if you see, it will come up to 3,60,000, less than 5 lakh. Trading value is becoming lesser than 5 lakh. After some time, SEBI will take the decision of increasing the lot size. So when it becomes 25, you can see the value will reach up to 5 lakh. So that is the minimum requirement for a lot size, that the trade value should be minimum 5 lakh in deciding the lot size. So it will keep on changing based on the price, and it is different for different options based on the stock and asset. Stock option versus index option, the difference. So stock option, the simple difference is stock option is only having monthly expiry. So it is only having monthly expiry. There is no weekly expiry concept in stock options. In index options, you have weekly expiry. Of course, you can trade monthly also. That means if I want to trade monthly for index, I can choose 4 weeks down the line or this month's last Thursday expiry I can choose. So I'm shooting this video on 13th of December 2020. The monthly option expiry will be 31st of December. Please note, it is not the last day of the month. For this month, it's both are the same. The last day is 31st and the last Thursday is also coming on the same day. Otherwise, the usual concept is last Thursday of a month is the expiry day for that particular month. So that holds good for stock options and index options. For index option, it is weekly expiry now. So it is also having an expiry on 31st. If you choose the expiry date, you will get 31st also. You will get 24. You will get 17. Okay. So 17 is the next weekly expiry. The last one was 10th of December for this month, right? That's how it goes. So that is a basic difference between stock option and index option. And now, why it is better to trade in index options on expiry day? As I said, on the expiry day, you have the right to execute the option contract, right? So on the expiry day, suppose if you're trading on stock options and for some reason you are not able to square off your position, you have a buy call option and you are not able to square off that position. It could be due to the liquidity problem, or it could be even your broker terminal is down. It can happen in that way also. It can happen, and for some reason that particular call option which you have bought has become in the money. That means at the day of expiry, if you're not squaring off the position, you have to take physical delivery of that stock. Okay, so what do you mean by physical delivery? That means if you have taken the call option strike price, you have to buy the stock from that seller, right? There will be a seller so that you can buy the call option, right? So the seller has to give that delivery of shares to you and you have to buy it at that particular strike price. So it will become a huge investment. So you need to have that much money with you. Otherwise it will be ending up in trouble. So that problem will be there. To avoid that, on the expiry day, if you are trading on only index options, so if you're not trading on expiry day in stock options, previous to expiry day itself, if you're squaring up all the positions, so all these problems will not arise. But for index option, there is no problem like that. There is no physical delivery. If a call option is going in the money for an index option, you will get the premium hike. If it is going beyond that, you will get that profit. And even if you're not squaring off that position, there is no physical delivery happening. So you don't have to worry on that. If it is not becoming in the money, your call option will become zero if you're not squaring it off. That's the only thing. Okay, I hope that is clear between stock option and index options. Okay, then you're good. But you can, on expiry day, you can trade on index option. Let's move on to the next one. Okay, so what is risk profile chart? The risk profile chart is a simple chart which shows profit or loss position of each trade which you have taken in option. It differs from the regular price time chart we used to see to monitor the stock or index price movement. Okay, so how to make this risk profile chart? A chart with y-axis as profit loss position range and x-axis as underlying asset price. A break-even line parallel to x-axis and also a risk profile. So these are the three things which you need it for a risk profile chart. This risk profile chart is very important. Risk profile chart for a long position, long call position, and this is the risk profile chart for a short call. Now let's look into the 4 basic strategies. So what are the 4 basic strategies? Long call, long put, short call, short put. When to execute long call? If you are bullish in view, that means you know, as we said, the example of Nifty 13,530 is the spot price. If you are seeing the spot price is going to go up to any value, maybe to 13,600 or something, okay, then you are going to buy the call option that is known as the long call, and it can be of any strike, but it depends on your profit also. If you're choosing your strike price correctly, your profit also will be more. You will be in profit, but you need to see how much of profit you will be. Similarly, if the position you are taking for a long call is not of right strike price, your risk also will be more. I will explain you how. So first let us try to understand this concept. So when to execute it? If your view is bullish, you will take a long call. What is the maximum risk? Your maximum risk is what is the premium that you are going to pay. So the loss is limited. Finally, at the expiry day, the premium is going to be zero for a call position which is not in the money. So the maximum loss can happen to you is only the premium what you have paid for buying that call option. So that way the risk is limited. You already know before you enter the trade, you know what is the maximum loss you can have it. And what is a reward or maximum profit? That is actually unlimited. Okay, because if you're having a bullish view from the Nifty spot price of 13,530, the Nifty can go to any extent, right? It can even go to 14,000, which you may not have thought about. Okay, Nifty can go to 13,600 from 530, but it has already gone to 14,000. So you will enjoy all those profits, right? If you are not squaring off the position by 13,600, you will be in much higher profit till 14,000 if it is going before that expiry, whatever you have chosen. Okay, now what is a win percentage? So if you have unlimited profit and your loss is limited, it is a win percentage. Will take a hit. Some or the other way it is going to take a hit, right? Otherwise everybody will go with this strategy. So the win percentage here is only 50% of short strategies. That is 33.3%. Okay, only 33% you can be right. If you are keeping your call option till expiry, that particular strike price going on a much higher value than your premium is of 33%. Capital required. The last traded price of strike price chosen into lot size. So for example, if you're choosing a strike price with strike price of Nifty of 13,500, which is trading at maybe 75 rupees. So that 75 rupees into the lot size, which is also 75. So 75 into 75. That much of premium you have to pay for buying that call option. Okay. And the proficiency is novice or beginner. So those who are beginning, that means after seeing this video, if you want to try out option, just do the same thing. In your trading terminal, just type Nifty, Bank Nifty, and what is the strike price you want, and choose your strike option based on the expiry. So for Nifty and Bank Nifty, you can choose the current expiry, the current week expiry as 17th, and you can buy that. So only the premium you are going to pay, that is the only loss you are going to get it also at the end of expiry. And if you are seeing it in good profit before the expiry itself, you can square off the position. So you don't have to keep it till expiry also. Fine, that is long call. And what is long put? If you know that stock is going to fall, so Nifty is trading at 13,530, and if you know that Nifty is going to fall below that particular 530 range, then you can take a long put position. Here also the loss is limited because you're going to buy the put, and you know that what is the premium you're going to pay for buying that. Only that much amount into that lot size you will be losing. And maximum reward, it is unlimited because the Nifty can fall even for a long price range also. You are expecting the fall of 30 rupees, but it has already fallen about 100 rupees or more than 100. Then in that way, the profit is unlimited. The win percentage, as I discussed in the long call itself, it is going to be 33.3% win ratio. And the capital required, I've already told, in the case of long call, same as long put also, traded price into lot size. It's a beginner strategy. And the risk profile chart, see here, this is the break. So when we talked about the risk profile chart in this slide, we told there are 4 lines, right? Y-axis, X-axis, break even, and risk profile line. So your Y-axis, X-axis, your break even. So this blue color is your risk profile line. The red color is your break even line. So how to create this? The break even is 0, and your blue line here, if you have paid 75 rupees into 75, so 175 here is the lot size, and this is your last traded price for the strike price you have chosen. Okay, so this amount will be or maximum loss you can get it at the time of expiry. It cannot go beyond that, right? So maximum loss is capped here, 75 into 75. This is your break even line. So anything which is going above that, so the strike price, if it is the Nifty price is going higher and higher, in case of a call option, you will have unlimited reward. This is the reward also will be higher. In the long put, similar way, instead of buying call option, you will be buying put option. So here also it's the same. The maximum loss can get here is then 16 to 75. That is the maximum loss you can get it at the time of expiry, and the maximum profit you can get is actually unlimited. It can go to higher value. In case of short call, right? What exactly is short call? You are basically going and selling a call option. Instead of buying it, you are going to sell it. When to execute it? You have a belief that that particular stock or index will fall. Okay, so you are going to buy a call option when you know that the stock or index is going to rise, but you are going to short the call option if you have a bearish view. And what is the risk or reward here? It is unlimited. The risk will be unlimited, and the reward is profit limited to the premium received. So it is just like the capital required here. The same way, the profit is capped, but the risk is unlimited. But what is the win percentage? It is 66.6%. And what is the proficiency required? Intermediate or advanced level of knowledge in stock option it is required. Otherwise, you can get into unlimited loss. And capital required, it is much higher capital required than the long strategies. Okay, because you have more win ratio here, so you need more capital, you need more proficiency in executing this one. Okay, and what is the risk profile chart here? See this? This is your 0 position, break even position, and this is the maximum profit you can get it. That means what? In this case, 75 into 75, that will be your maximum profit. And what is the maximum loss? If the stock price is going much higher, your loss is going to be even more. So you can always get out from this. You can square off your position at any point before the expiry, and you can get out. Similarly, what is short put? So this is selling a put option. Okay, similarly here, this is the break even point, and this point, it is the maximum profit you can get it. In this case, 16 to 75, that is the maximum profit you can get it. And if the stock option is going way below what is expected, then your loss is going to be unlimited. Okay, because you are expecting the stock to go higher, but the stock is going lower and lower, and your loss can be unlimited. And as I said, you can exit from this position anytime. Okay, so this is the basic of options and basic of strategies. I hope you might have liked this video. You might be able to understand something, or if you're already trading in options also, you might be able to learn something out of this few slides which I prepared. And I'm going to continue the next episode with option Greeks. This is the slide for next week episode on option Greeks. So what are understanding option Greeks, how option Greeks affect option premium, what will be the option Greeks for each of the 4 basic strategies. So that's all for this episode. Thank you for watching. If you like the video, click the like button, and please subscribe to the channel so you will not miss any other videos coming out in this series, and you will also not miss the live stream what we are doing for post market analysis and intraday stock selection video. Okay, thank you for watching. Have a nice day. Bye bye.